This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, well, onwards now to hopefully at least the last session within this particular chapter, chapter 12. And the next area that we look at is an area known as part disposals. Now, we know the basic calculation of the gain. What's the sales proceeds, or if a gift, use open market value. What are the selling expenses, less than what are your allowable costs. Now, in calculating a capital gain, or indeed a capital loss, if you're going to have a problem in terms of that calculation, the problem tends to arise around the determination of the allowable cost. And that's the situation that we have here in the context of a part disposal. What will be happening is that we at some point in the past will have bought, shall we call it, an entire asset. But now, at this point, we sell some, but not all of that asset. How that might be, we'll talk about in a few minutes' time. So when we sell some, but not all of that asset, what do we know? We know our sales proceeds for the sale of this part. We know any selling expenses that we incurred. Our problem is, what is the allowable cost? For what we know the cost of is the entire asset, not just the bit now being sold. So clearly, some apportionment of that original total cost must now take place, so as to determine what would be a reasonable amount of that total cost to now expend against the proceeds of this part disposal. What bit of the total cost should we use? Okay, as you might guess in a situation like this, it's not left up to us to decide as the taxpayer how much of that original total cost will now deem to be used on this disposal. There will be a rule. And what we're told here, an explanation of how this might be a problem. How is it that we can sell some but not all of an asset that once we had originally acquired? So a chargeable asset may be only partly disposed of, as we said. For example, land. A taxpayer acquires 100 hectares of land, but subsequently then sells 40 of those hectares. So what we know the cost of is the 100 hectares. What we can now deal with on the sale is we know the sales proceeds of the 40 hectares. Now, of course, this disposal will give rise to a calculation, at least, of a gain. It could end up with a loss, but we're going to find a gain here in the normal way. But a specific problem, as we said, arises regarding what figure of cost should be used within the gains calculation. We know how much we have sold this part for, the proceeds on the 40 hectares. We know any selling expenses that we've just incurred. What we don't know is what cost should we use for 40 hectares when the cost that we have is that of 100. Now again, you might think, well, that's fairly easy. If we know the cost of 100 and we're now selling 40, just take 40 100ths of that cost, and that'll be the cost of the bit that we're now disposing of. It might sound like a sensible idea, but as you might therefore guess where this is going, it's not the rule that we use. We don't use here a quantitative basis in terms of physical quantities. We're selling 40 hectares out of 100, take 40 100ths. No, instead what we must do is to use a value-based apportionment to split out from that total cost what is the deemed cost of the bit now disposed of. So, it may seem appropriate to use 40 100ths of the original cost, but that is not what we use. Instead, it's a market value-based apportionment of the total cost. The cost of the whole asset is multiplied by the following fraction to compute our allowable cost of the part now sold. Now again, you'll see this in all the text. We have this fraction, A over A plus B. Now again, there's no point learning A over A plus B if you don't know what the A or the B stands for. So what you've got to learn is we are going to multiply out the total cost by, on the top line, the gross proceeds, so before any selling expenses, of the part that now is disposed of. How much did you sell this bit for? Over that same figure, So gross proceeds over gross proceeds, again, of the bit now sold. And that bit plus B, that's the market value of the remainder of the asset. The market value of the remainder. That is a figure that you can't make up for yourself. It's got to be given to you by the examiner and will be given in the exam. Before you have a go at example 8, let me just take you through a little exercise here. So if you could just get pen and paper and note down this particular example here, please. I'll talk you through it. You need to pause it, do so, and then come back and we'll work this together. But taxpayer purchases land at a cost of £60,000. Subsequently sells some of that land for £70,000, incurring selling expenses of £2,000. Yeah, you know the proceeds, you know the selling expenses on the bit that you've now sold. Following then the sale of the then the remaining land still owned by the taxpayer was valued at £50,000. The key bit of information that the examiner must provide you with here, otherwise we can't do our gains calculation. So how do we now compute the gain arising? Again, if you've not yet noted that down, please pause, get that noted down, and then rejoin us, and we'll have a go at the calculation of the gain now arising. Okay, so how do we calculate that gain? What are our sales proceeds? £70,000 less our selling expenses. They, I think, were £2,000. So we're down to net proceeds of £68,000, from which we now need to deduct our allowable cost. And herein lies the problem. What do we know the cost of the original entire asset? That was £60,000. What we now need to do here is to establish what proportion of that is the allowable cost to deduct in deriving then what will clearly be a chargeable gain figure on this part disposal. Answer: top line sale proceeds, gross sale proceeds. That was 70,000. Over bottom line, 70,000, the self-same gross proceeds, plus the value remaining, the market value of your remaining interest. That, we're told in the question here, is £50,000. There you go. What's our allowable cost, therefore? Well, 60,000 times 7 over 12, 70 over 70 plus 50, 7/12, therefore, of that 60,000, which I think will be £35,000. Take that away, and that will leave us with, what's that, a chargeable gain of £33,000 now arising. And that, therefore, is how we deal with a part disposal. One interesting little point just to watch out for, most likely again at this level, if they set a part disposal problem, it'll be that one there. We bought the entire asset, we now sell some, but not all of that asset, compute the gain. They're testing, do you know how to determine the allowable cost of the part now sold? It is the original total cost multiplied out by proceeds over proceed plus value remaining. If, by the way, you had here any individual cost that was only incurred on the bit that you are now selling, then that would be deducted in full. This calculation here, this fraction, is only applied to common cost, that which relates, I should say, to the entire asset. If you've got some specific expenditure just on that bit now sold, then that would be deducted in full. That said, what other problem could you get? What you might get in a problem like this is that this sale, in fact, is not taking place this year. It took place a year ago, 2 years ago, sometime in the past. So this is not the gains calculation that you're doing, because what you're now told is that you now sell the remaining part. you now sell the remaining part. So again, when that sale takes place, you'll know your proceeds, you'll know your cost. The selling expenses rather. So you'll know your net proceeds. The question mark is, what allowable cost should there be? What you would have to do is to go back to this part of the original calculation of the original gain. When the first part was sold, how much of the cost of £60,000 did you then expend? That was, as we've seen here, and hopefully you follow and understand, was £35,000. So as soon as that happened, it meant that the cost of the remaining part would be the balance of £25,000. Of 60, we have expended 35 on that first disposal. So the second disposal of the remaining part of that property must have an allowable cost of 25. Now that would be a more interesting, a more challenging question, of course, there, obviously, that to be able to work out the gain on the second disposal of the remaining part of the asset still then owned, you need to have been able to work out how much of the original cost, their 60, had you then originally expended. That was 35. We don't care about what the then gain was, that was taxed years ago. What we want to know is how much cost remains. I had 60, I've expended 35, I'm left with 25. Okay. Can you now, therefore, if we go back to your chapter, have a go, as we said, at example 8 there. So pause, please, have a go at that example, and then rejoin us again. Okay, well, on we go, hopefully successfully, having dealt with that previous example there. Now to look at chattels. Now then, that word chattels, we've seen that before. Might seem a long time ago now, but it was back in that first introduction to CGT at the beginning of this chapter, where it was in a list of exempt assets that we included the term certain chattels. Certain chattels. We're going to see now in this note which of those chattels may indeed be exempted and which will be chargeable, and any specific rules for dealing with chargeability. Okay, what do we know about a chattel? Definition: tangible, movable asset. What we're then going to see is that these chattels will be split into two categories: those which are wasting chattels and those which are non-wasting chattels. Firstly, the wasting chattel. That one is an easy one because any such wasting chattels are exempt assets. What is wasting? A wasting chattel is one with an estimated remaining life of 50 years or less. When now you dispose of it, it's got an estimated remaining life of not more than 50 years. Typical examples used by examiners across the years would include racehorses, greyhounds. If you're not familiar with what a greyhound might be, they are a particular type of dog, and like racehorses, they race. Therefore, they may have potentially significant value, therefore may indeed be disposed of at a gain, or, of course, they have very little value and are disposed of, well, let's hope not disposed of, but they come to a natural end with no value at all there. So what happens is that wasting chattels are exempt. The idea, of course, being here that if it is wasting, as you get ever closer to the end of the life of that particular wasting chattel, whatever life that might be, given the definition of a life of 50 years or less, then as you get towards the end of life, its value is going to go down. So what HMRC are doing here is to basically do themselves a favour. Yeah, there might be the odd circumstance where gains that might have arisen are not now taxable. But in most cases here, such assets, such wasting chattels, are going to go down in value. The third one here, yachts, boats there. Again, they say that the two happiest times in terms of your ownership of a yacht or a boat is firstly when you buy it, and secondly, even happier, when you sell it, because they go down in value hugely there. Hopefully they don't go down, but they go down in value there indeed. And on that basis, it's very likely on a disposal to give rise to a loss. Well, here, It won't be an allowable capital loss. You won't be able to use this against any other gains. This is going to be exempt. So, disposal of wasting chattels, exempt. Neither a gain nor a loss will arise. So what about the non-wasting? Those, of course, with an estimated remaining life of more than 50 years. Your typical examples, I think we probably mentioned these indeed at the beginning of our discussions at the start of this chapter, would include typically antiques, paintings, items of jewellery, for example, there, anything collectible basically there that has an indeterminate life. But there are special rules, though, to deal with any gain or loss that might arise. And what we have to learn here is a cut-off figure of £6,000. That if the cost does not exceed 6,000 and the proceeds, we sell it for not more than 6,000. If we both buy and sell this chattel for less than £6,000, then any such disposal will be exempt. So I bought an antique for £3,000, I dispose of that antique for £5,000. Neither the 3 nor the 5 exceed 6. Bought for less than 6, sold for less than 6, it is therefore exempt. Now, before you go off and think, yeah, I can see a little gap in the taxation system here. All I've got to do, therefore, is, hopefully successfully, buy and then sell antiques for more than I paid for them, and on that basis there'll be no tax. Wrong. What you would have is that there would be no CGT. But if you are buying and selling assets with a view to making profits, what are you doing? And what tax will that give rise to? Think back, I think it was to the beginning of chapter 4, where we looked at something called the badges of trade. And what we saw there was, how do we distinguish a capital transaction that may then be subject to CGT from a trading transaction? If you are buying and selling with a view to making profits, that's trading. Therefore, though indeed it would be exempt CGT, you'd have a trading profit. This is a trade. Trading profit must therefore be computed, and income tax would be chargeable thereon. Also, of course, on trading income, the possibility of national insurance contributions also arise, depending on how much trading profit there is for any tax year. But here in capital gains, any such chattels bought and sold for less than 6,000 are exempt. If both the figures are above 6,000, I buy for 10, I sell for 15, or as we saw, I think in our very first example, we buy for 15 and sell for 10, then both those numbers above £6,000, it's a normal calculation, and either a gain, or as in that last example, a loss may arise. So, of course, what we tend to get is examples that fall between these two extremes. That one of the numbers, either the cost or the proceeds, is below 6,000 and the other is above. What do we then do? Well, what we'll do is to see that if we buy for less than 6 and sell for more than 6, we will minimise the gain. There will be marginal relief. We'll compute what the maximum gain could be. Whereas if we buy for more than 6 and sell for less than, we've incurred a loss, then we will limit how much of that loss is allowable. So what are the rules? Firstly, if we buy an item here for less than 6,000 and we sell it for more than 6,000, two calculations to be performed. Firstly, your normal calculation. What did you sell it for? What were your selling expenses? What is my allowable cost? Work out the chargeable gain or allowable loss as the case may, well, here not, sorry, allowable loss. We bought it for less than 6, we're selling for more, there is clearly a gain that arises. So two calculations, normal, what did you sell it for, less the selling expenses, less cost, but then limited to, restricted to a maximum, and this I'm afraid not something given on your rates and allowances page, you're going to have to learn this one. We take the excess of the gross proceeds minus £6,000, that's the exemption limit, 6,000. We compare gross proceeds, not net, gross proceeds with that 6,000, and multiply that figure by this fraction, there's the bit you're going to have to learn, 5 over 3. Multiply that by 5 over 3. So let's give you a little example of that, if I may. So let's just again go to a bit of blank paper here, and you are told this. We're told taxpayer sells an antique for let's say £7,000. Now let's make that 7,500. Apologies there, fool. 7,500. I want to keep the maths as easy as possible. 7,500 incurring selling expenses of £200. Incurring selling expenses of 200. What you need to know, of course, what was the original cost? Cost of asset was £3,000. Now, clearly, we here are doing an example straight off the back of having introduced what the issue is. We're dealing with chattels, and we're dealing with a chattel that was bought for less than 6 and sold for more than 6. In an exam question, you've got to work out that that is actually the situation, firstly, that you're dealing with. So as you read it, you read sells an antique. Ding! In your head there, that is a chattel. There's a £6,000 exemption rule that applies here. So let's have a little look. What do I sell it for? £7,500. What did I buy it for? £3,000. Right, I've now analysed the situation. This is a chattel sold for more than 6,000 that was bought for less than 6,000. So there's the tricky bit in your exam question. You actually recognising what they're testing you on in the first place. If you don't do that, then you're not going to know which bit of knowledge to go to in that head of yours for use in answering that question. So that's the first thing you had to do. Okay, when we see sold for more than 6, bought for less, 2 calculations to do. Firstly, a normal gains calculation. Sales proceeds, what do we sell it for? £7,500. Take away your selling expenses, 200. Net proceeds, £7,300. Take away your allowable cost, that was 3,000. So we're talking about, oops, more than that, we're talking about a chargeable gain arising here of £4,300. There's your actual gains calculation. So there's nothing different there to what we've always done. What do we sell it for? What's the selling expenses? What's the allowable cost? Work out the gain. But because this is a chattel that was bought for less than and now sold for more than 6, we now calculate in our second computation here that our maximum gain, this is restriction, our maximum gain will equal. What were our gross proceeds, not the 7,300, but the 7,500 minus 6,000. What are the, or is the excess of the gross proceeds over the 6,000 exemption limit? That here is 1,500 times 5 over 3. Now again, that's why we change those proceeds to 7,500, makes this calculation a little bit easier, I hope. 7,500 minus 6,000, 1,500 times 5 over 3. That therefore will come out to a maximum gain as £2,500. Is that figure less than 4,300? Of course it is. Therefore, that is the maximum gain that will now arise. The taxpayer will not be charged on the actual gain. It will be limited to that maximum figure. Now, in this situation, where you sold for 7,500 and you have an exemption limit, as you always do, of 6,000, then the maximum gain was always going to be 2,500. If that actual gain was, say, only £2,000, then you'd use the actual gain. This is just a limiting factor. It's the maximum. If the actual is less than that maximum, you will use that actual figure. Here, though, the maximum is lower, so that's your outcome. Thank you very much. Job done. Okay, back to our notes. The other way around. This time it cost more than 6,000 and we sell for less than 6,000. Hence, therefore, there is going to be a loss. Now, in the same way that where one number was less than, another number was more than 6,000, and we had a gain, we limited what the maximum gain would be. So when it's the other way around, and we're now looking at a loss, there will be a limitation of what is the allowable capital loss. This time, however, we don't need two calculations. There's just one calculation to do. And what it is, we do a loss calculation based on deemed gross proceeds, note, equal to £6,000. That's the rule. One calculation. We know what the actual cost was. It was something more than £6,000. And what we now do is to deem the gross proceeds to be 6,000, thus limiting the allowable loss. So, one final example on this, therefore, let us now assume taxpayer sold a painting for £4,000, incurring, again, selling expenses of £200. Original cost, bad news, wasn't a good judge of a good artwork, was £7,000. Right. Get that noted down, then look back at the note that we've seen as to how to deal with this, and understand that yet again, in an exam question where you've not just looked at the note on Chattels, but this is a random objective testing question where they're asking you to work out what allowable loss here has arisen, you've got to understand that you recognise that what is being sold, a painting, is a chattel. It's not a wasting chattel there. It's a painting. It's sold for 4,000. That is less than 6,000. It was bought for 7,000, more than 6,000. That, therefore, is where this rule that now you must apply comes in. But the hardest part here is actually knowing that this is the rule being tested. You have to work that out from the information in the question. So what do? It's one calculation of the loss where we have our deemed gross proceeds, you can just put sale proceeds if you wish here, to be equal to £6,000. Deemed gross proceeds 6,000. Less, we said they were gross proceeds, so we still get to deduct any selling expenses incurred. They were what? They're £200. Take that away. Thus giving us, again, with an objective testing question, you wouldn't be writing this out in detail. They're only interested in you coming up with the right answer. So net proceeds, 5,800. Therefore, less, what was our original cost? What did we buy it for? We can see there, £7,000. Deduct our 7,000, and that will give rise to what will now be our allowable capital loss of £1,200. Thank you very much. Job done. There is your allowable loss. Yet again here, when dealing with chattels, you've firstly got to recognise in the question what the issue is. Is the asset being disposed of a chattel covered by any of these rules here? If so, what did you sell it for? What did you buy it for? Compare each of those figures with the cut-off exemption limit of £6,000, and once you've analysed the situation, go on to compute either gain or loss that has arisen. Okay, going back to your chapter, what you have then, example 10. For you to calculate the net gains or losses arising for our hero JM in December 17, where these disposals occur. Over to you, therefore, now to have a go at that, please. To check out then your answer with the answer in the back. Make sure you're happy with that model answer before then rejoining us again for the last little bit on this chapter. Okay, well, there's light at the end of the tunnel. We're very nearly at the end of this extensive chapter here on our introduction to CGT. Hopefully you've worked through the answer to that. You would have recognised on the first run through, I hope, what the issues were. Again, antique table, it's a chattel, cost 3,000, sold for 5,000. That therefore is exempt. No gain or loss arises. Both of those figures less individually than 6,000. Painting which cost 2,000, again a painting of course is a further chattel, cost 2,000, sold for 10,000. Here we go, bought for less than 6, sold for more than 6. That's the two calculations required, the actual gain limited to, if necessary, the maximum gain figure. Next one, antique vase, again a chattel there, cost 8,000, that's more than 6, sold for 3,000, that's less than, therefore we use the deemed gross proceeds there of £6,000 in computing the allowable loss. And then car, go no further. Doesn't matter whether it's a vintage car, doesn't matter whether it's a more recent car, a car is exempt. Don't have to worry about the chattels rule, cars are exempt, end of story. Whether vintage or otherwise doesn't matter. So that too is exempt. Hopefully the calculations on B and C you're able to do. You can see the answer at the back. Do please make sure that you've reviewed through that and you're comfortable with those exercises on chattels. And so we come to the last of our areas now. Right, it refers to other wasting assets. Remember what a wasting asset is. A wasting asset is one with a life of not more than 50 years. And if it was a wasting chattel, then it would be exempt, end of story. The racehorses, the greyhounds, the yachts there, all of those would be exempt. But these are assets that are not chattels. Therefore, the exemption does not apply. Therefore, a gain or loss must be computed. So what are we talking about? Now, best example I can give you anyway of a wasting asset would be something like a copyright there. On that basis, something you own like an intangible there that has a specific life. It exists for a period of time, not more than 50 years, making it wasting, but is not tangible. You can't touch it there. It's not tangible, movable property. Right, the problem. What we know is when we sell it, how much we sell it for, and if there are any, what the selling expenses are. So we can always get the net proceeds. The problem as ever, and this will be proven to be the case in our next chapter as well, is in working out allowable cost. Because as the life of that wasting asset ticks away, as you get ever closer to the end of the copyright period or the patent period there, whatever the intangible might be, as you get ever closer to the end of that life, then the value is going to go down. And that means if the value is going down, then HMRC would be more likely to give an allowable loss. So clearly what they're going to do is if the value is depreciating over time as you get closer to the end of the life of this asset, then so too will they depreciate the cost figure to match like with like. So how do we deal with this? The allowable expenditure, this is always the problem, is deemed to waste away over the life of the asset. Here with this type, something like a copyright there, we will deem the cost to waste away on a straight line basis, so that when a disposal is made, the allowable expenditure is restricted to take account of the asset's natural fall in value. This fall in value is deemed to occur, as we've just said, on a straight line basis over its predictable useful life. Again, with something like a copyright or a patent, you would know exactly how long that will last for. Therefore, to compute the allowable cost, the original cost must therefore be reduced by the following. Now be careful what we're saying. This is the amount that we're going to calculate here with this weird and wonderful calculation there. The amount that the original cost must therefore be reduced by, not to, by. So, what is this figure? P over L, period of ownership of the seller, over the predictable life of the asset when the seller bought it, on the acquisition of that. So how long is left? How long have we owned it for? The period of ownership of the seller, over what was the original predictable life when we acquired. And what do we apply that to in this depreciation of the original cost? It is that original cost figure, C there, but minus is if there is any, and quite often there isn't, so it's just times by the cost. But if there were any, less any scrap value there at the end of the asset's predictable life, any residual value that might exist for this asset. Now again, I repeat, this is the reduction that you apply to the original cost figure. So what have we got? Calculate the chargeable gain arising on the sale of the copyright in December 17. Z Limited sold this asset for $38,000 on the 1st of December 17. So we know, therefore, what our sale proceeds are. As ever, sale proceeds, $38,000. If there were any selling expenses, we would equally know what they would be, and we would deduct them. Less. Now, what we know is that we're going to be deducting our allowable cost. And it's getting that allowable cost that is the problem. So what do? We pick up, of course, as the starting point, our original, acquisition cost. Don't worry about that abbreviation. It's the original acquisition cost. So how much did we pay for that original cost, the original acquisition? On the 1st of December 05, bought a copyright at a cost of $25,000. Now, the first thing you might remark on here is, hang on a minute, you told me we were dealing with a wasting asset. One, therefore, that the value would go down on in relation to the reduced life. As the life ticked by, got ever closer to the end of its life, the value would go down. Well, be careful. Yes, the passage of time will reduce the value of that particular asset. Clearly, something with a life of 30 years is going to be worth more, the equivalent asset that is, to if it had 20 years. But there are other factors that will dictate, of course, the value of such an asset. That when we acquired it, the copyright on whatever it wasn't that fashionable, wasn't therefore worth that much. And suddenly what we've now got, the copyright, the value has gone up. So the passage of time has brought it down because you've got less to sell than you bought, but the actual value of what it is that you are selling goes up. So don't here be concerned by or think you do something else just because now when you sell for more than the original cost. This exercise with this restriction being applied, reducing the cost, original acquisition cost by that figure, this always applies. Whether it has gone up or gone down in value doesn't matter. So less. Right. You have a look at what that calculation was. Again, let me just clear that so we can see clearly what we have got here. We have got period of ownership of the seller, that was on the top line, over what was the predictable life of the asset on acquisition. So what are we told? When they bought it, Z bought the copyright at cost 25, it had an estimated useful life of 30 years. So the bottom line in this calculation is 30. We've also then got an estimated residual value of £1,000. Right, so this part of the calculation, what was the cost of the asset? It was 25,000 minus, does it have any residual value? Yes, it does have residual value. That was £1,000 minus 1,000. So all we need to know is what's the numerator in this calculation. Let's again look at the dates. Acquired 1st of December 05, disposed of 1st of December 17. Therefore, top line, period of ownership of the seller from 1st of December 05 to 1st of December 17. Hopefully we would therefore agree 5 away from 17 is 12. Put that through your calculator. So this therefore 12/30 times 25,000 minus 1,000. I think that was what we had there. Yep, there we go. And that is a deduction. That's a deduction from your original acquisition cost to give you the allowable cost to then feed in to your gains calculation. So put that through your calculator, get your figure. That then will give you your allowable cost, which you'll deduct in deriving your gain. Again, if need to, just pause there for a second while you do that, or otherwise, we will just look through to our answer to this problem, where we will see. There's your proceeds, 38,000. How do we work out our allowable cost? What was the purchase cost? 25,000 less. How much life out of the 30 years life when we bought it have we used up as the vendor? 12. That's the bit that's been expended by us. We reduce our original cost by that part expended. But it's not just times the cost figure of 25, if there is any. Quite frequently in the exam questions there won't be, but we'd reduce that by any residual value. That would appear here to be 9,600. Take it away, and thus you have your allowable cost of 15,400. Take away from your proceeds of 38, and there is your chargeable gain. So it's remembering here that this calculation in here, where you have to learn, and now is not the time, unless now is a few days before the exam, closer to the exam date is when you'll come back and have a little look at this. But that is the restriction there that you apply to the cost. That calculation does not give you the allowable cost. That is the amount by which you restrict your original cost to give you now the allowable cost. Okay, we've looked therefore at varying situations about how to calculate either a gain or a loss. Probably one of the chargeable assets, the most disposed of, most transactions in terms of disposals in chargeable assets by people during a tax year, may very well be disposals of shares. And like we've seen in terms of the story so far, if you're going to have a problem calculating a chargeable gain figure when you make a disposal, 9 times out of 10, it is computing the allowable cost. And when we deal with shares, that will be no exception. The problem will not be how much are we selling these shares for, or when we give them away, what is their market value. That we can handle, or it's just given to you in the question if it's the sales proceeds. The problem is what's going to be the allowable cost of those shares. You might think, well, where's the problem? I bought some shares, I sell some shares. I know what I paid for them, I know what I sell them for. But of course, in real life, what you may have, and certainly in an exam question, what you will have is you didn't have one acquisition with just one cost figure. I've gone out and accumulated my current ownership of shares in a particular company by buying some shares 20 years ago, 10 years ago, 5 years ago, 2 years ago, a month ago. And now I sell not all of them, but some of those shares. The question is, which ones am I selling? Of course, I know how much I'm selling them for, but I don't know whether their cost is the cost of the shares I bought 20 years ago, 10 years ago, 5 years ago, a month ago. What cost figures should I use? Do you really think that HMRC would leave that decision up to you? Not a chance. There are rules that you are going to have to learn. But the pleasure of that awaits us in our next chapter, chapter 13.